Well, global markets were spooked in February on concerns of trade wars driven by U.S. President Donald Trump's tariff rhetoric. Well, March is usually a good time for markets. The broad economic risk from trade wars and the cautious tone in the background will test investors' resolve. Let's take a look at WION's monthly global markets and economic health check to see what happened in February. Broadly, commodities, digital assets, and the dollar fell, driven by differing bets, with U.S. President Donald Trump driving tariff headlines almost every other day. Bitcoin crashed over 25% from its new record high hit on Trump's inauguration day in January. Gold was the biggest beneficiary in February, hitting multiple record highs. The yellow metal's shine was driven by safe haven bids from rising trade war fears from Trump's tariff rhetoric. Crude oil tumbled as talks of an end to the Ukraine war have stemmed supply fears, and at the same time, global economic concerns weighed on the demand outlook. Moving on to the Asia-Pacific stock markets, the sudden shift away from risk assets hit Asian markets. Most regional benchmarks closed deep in the red in February. Chinese stocks, though, were the exception, driven by tech stocks after a DeepSeek-led rally. Japanese stocks took the biggest hit in the month, down over 6%. The story in American stocks was no different, with the S&P 500 and Nasdaq reversing from record highs to close out the month in the red. Nasdaq was hit the most, led by a significant decline in tech stocks. Canadian and Brazilian stock indices closed out February with losses. European stocks ended February in the green, driven broadly by solid earnings reports and increased military spending expectations, boosting defense shares. Stocks across Europe and Africa gained, with an eye on the Ukraine peace deal also helping sentiment somehow. The German DAX was the biggest gainer in February. Well, now let's turn our attention to the overall economic outlook. Let's look at the Asia-Pacific region. Now, Trump's trade war worries have weighed on the outlook for global economies. While India is still expected to be the fastest growing major economy in the world, bets are for a significant slowdown. The biggest worry is a fall in demand, which is weighing on sentiment for India. The outlook for the West in Asia also remains negative. For China, the outlook is still mired in doubts from trade war worries and the recession in its real estate crisis. In the Americas, the outlook for the U.S., Canada, Brazil, and Argentina shows trade tariffs are likely to hurt economic growth. For the U.S. economy, recession bets are back on the table. The economic activity expectations in Canada, Brazil, and Argentina were also cut. On the other side of the Atlantic, the negative outlook seems to be more widespread. The UK and the European economies will likely avoid a recession, but expectations show the clouds are darkening again. The outlook for African economies also remained negative. All right, and to discuss more, we are now being joined by Dr. Andrew Freire, CEO, Equinox's Advisory Limited, live from Montevideo, Uruguay. Thank you so much for joining us on the broadcast.
A pleasure.
Let me begin by asking you, well, with the recession fears looming now, what strategies should U.S. investors adopt to navigate potential market volatility in the near future?
First, number one, I don't feel in the slightest sorry for the half of the Americans that voted for Trump and for the rest of the markets, because they are getting what Trump said he was going to give, and they are getting it and they don't like it. Okay, they don't like the tariffs, they don't like the dissension, the political dissension, they don't like Trump joining a dictator that is Putin. Okay, so they voted for it, they're getting it. And they are not getting the performance in the stock market. Why? Because additional tariffs, please watch my lips, are going to be paid by the American public, and that is going to raise prices. So inflation in the United States can be expected to rise at least for the rest of this year, and if not, for perhaps into next year, and that means that the Fed is not going to cut interest rates. So much, thank you very much for voting Trump. You're not going to get lower interest rates, you're going to get higher inflation, and you're going to get all the impacts on the stock market. The big seven, all those millionaires standing behind Trump, count them, seven of them. Okay, you know how much they lost collectively since the 17th of December? 1.5 trillion US. Worst hit was Elon Musk. Okay, that's what you get by supporting Trump. I'm sorry, I'm not being anti-Trump. The guy is doing exactly what he said he's going to do. He's incredibly honest. The fact that the things he's doing are not necessarily right does not mean that in any way he's cheating or misleading the American public. That's what they're getting. So American stock markets should be on a negative watch because they are not going to get cut in interest rates. They are going to get higher inflation. And clearly Trump will continue to do what he's doing now, particularly with tariffs. And tariffs are hurting the American consumer. Full stop.
Right. Well, now that was the Americas. Let's move to Europe now. Given the positive momentum that we just showed through our report in European stocks, what factors could sustain this growth there?
More spending on defense. Look, I have been a huge defense fan for nearly 2.5 years, and I paid for it because supporting companies that make guns that kill people and things is not a great idea, but on the other hand, it is a sound economic idea. And of course, now Europe is going to spend more than ever on defense, and their defense sector is doing extremely well. Incidentally, the American defense sector, that should be doing also extremely well, is not, because the writing is on the wall. We're not going to rely on them. We're going to I'm talking about the Europeans, make our own arms and buy as few arms as possible from the United States. And this should also be a huge lesson to India. We'll come to India in a moment, where I'm also a huge fan of the Indian defense sector, but I'm jumping the gun. So the European Union is going to have a mediocre growth overall, but supported by additional defense spending.
Absolutely. Now, that's considering that NATO is also scared about spending, defense spending. That's a really interesting point you put there. Now, considering you talked about India, considering the economic slowdown concerns, what steps should India take to ensure its stocks market and retail investors continue to thrive amidst this global uncertainty?
With your permission, can I be a little bit tough and a little bit forward? Give me a big smile. Okay, I can do that. Good. Look, India's exports are about 22% of GDP. 22% of GDP. India's exports to the United States are about 18% of all its exports. Do the multiplication and you get about 3.5% of India exports go to the United States. They don't matter. Trump can put all the tariffs he wants on Indian exports, and what? If they cut them in half, India is going to lose 1.5% of its GDP. So can we please ignore what Trump is doing on the so-called war of trade, because it's not a war of trade, it is war of Trump against everybody else. India is not threatening Japan to impose tariffs. India is not threatening China to impose tariffs, but Trump is threatening and is imposing tariffs on these two countries. So in the case of India, look inwardly, okay, a huge domestic market. Can you please forget about the tariff issue and don't send anybody else to Trump to negotiate? Okay, you see what happens. Okay, he treats everybody as his subjects and simply stick to a well-armed, well-provisioned India. If a country is not well-armed, nobody pays any attention to them, and they will tend to treat it like they are trying to treat now Ukraine. If you don't believe me, look what's happening. So in India, I'm bullish because I know there is a big defense sector which is going to benefit by India arming more. I know it's a horrible thing to say, but that's the reality. That's the real world, not me.
All right, that's a very interesting point you put out there. Let's take a look at this globally now. How do you expect global markets to respond in the coming months if trade tensions do continue to escalate?
Okay, let's do that again very, very simply. Again, you will give me a big smile, right? If I can be a little bit tough here. 11% of global trade is handled by United States. 11% of global trade. The other 89 is not. So there's nothing to discuss here. Let's concentrate on the 89, which is between us and not with Trump, and things will be perfectly all right. You know, this incessant fear that whatever the United States does is going to impact us is fundamentally and quantitatively wrong. It's as simple as that. Okay, so I take with a pinch of salt that because Trump is going to impose all those tariffs, global trade is going to collapse. No, it will not, because global trade is primarily between everybody and not Trump. There will be, let's call them domino effects, and there will be resonances. Of course, if one export market gets hit a little bit and then potentially its exports to somebody else might get hit, but we're talking about very, very small amounts. So frankly, when I look at the global economy, I'm much more concerned about the political uncertainty, rather than what is going to happen to global trade. Okay, global trade is not United States. United States accounts for a very small percentage of it, so let's forget it.
Absolutely. Now, you gave us a very comprehensive outlook of to what we expect from the global markets, of course, and region-wise. But thank you so much for giving your perspective and coming on the show.
Thank you for smiling.